Ngā mihi kia koutou, e ngā mana, e ngā waka, e ngā reo, e rau rangatira mā, tēnā koutou katoa, ko Kate Vennell tako ingoa, ka hui o ki te reo ingarihi. Hello everyone, I'm Kate Vennell, co-CEO of Mindful Money. I'm delighted to introduce a special podcast in which I interview Dr. Rodger Spiller, a trailblazer in ethical investing. This episode is part of an Ethical Investment Week, and we're going to hopefully offer you some insights into aligning your investments with your values. Before we get going, we want to note that this podcast is purely educational. This means that everything we cover is for the purpose of giving information and providing education. It is not financial advice. So, welcome, Rodger. Firstly, tell us a bit more about Ethical Investment Week.
Thanks, Kate. It's great to be with you. The purpose of Ethical Investment Week is to connect investors with advisors who are specialists in the ethical space, with the purpose of ensuring that your investments are best suited to your beliefs, attitudes, and ethics. As part of Ethical Investment Week, members of the Ethical Advisors Co-op are presenting a range of webinars and podcasts. Activities are listed on the Co-op's website, and many of those will still be available after the completion of the week. There's a range of other resources on that website worth checking out. For example, the theme for Ethical Investment Week 2021 was wayfinding for ethical investment, drawing upon my partner, Professor Rodger Spiller's wayfinding research in her book, Wayfinding Leadership, published by Huia in 2015. Shelley and I provided an in-depth webinar that offers a journey of discovery for ethical investors that listeners might want to check out.
Okay, that sounds a great resource. And it's a really interesting topic. And I think starting to unpick the layers around this, some of the people listening to this might be coming from the financial goals or needs perspective. And they might be wondering questions like, will I have enough savings to retire and also live well? How do I organize my finances? I've just gone through a relationship breakup. How do I protect and grow a sum that maybe I've been fortunate to acquire because maybe I've sold a business or, I've gained an inheritance. So from your deep experience, which is, really over 34 years, you are the father of ethical investing. What have you seen as benefits for people from being supported by an advisor?
Well, like a specialist medical doctor, an expert advisor can draw on their extensive experience, their advanced education, their knowledge of financial planning, clients, markets and funds to diagnose your situation, including your current personal and financial situation, your goals, investment timelines, investment risk profile, and ethical investment profile, and then take that information to prescribe a customized plan showing how your goals can be achieved and a portfolio of the optimal ethical investment funds, much like a doctor prescribes medications, then implement and monitor, like a doctor, changes in your personal situation and goals, changes in financial markets and funds, and recommend changes to your plan and the prescribed investments as needed. So the intention being to enable you to keep your financial situation as healthy as possible, doing well financially and doing good in terms of ethical considerations.
I really love that analogy of the financial advisor as a doctor, and it's about financial health. I love that analogy as well, that this is about being healthy and helping the world to be healthy. So in your experience, working with an advisor can help you to create a financial plan. How do we think about risk in that consideration? Yeah, well, what do you mean by that?
There's a range of ways of defining risk. We can certainly say that a big risk is not achieving your goals. And I heard this morning that quote about you miss 100 of the shots on goal that you don't take. So it's important to do something because it's pretty risky to do nothing for most people. Now, I'd say that everyone really can benefit from having a financial plan to help secure their financial future, provide security and stability for any dependents, and that it is really a fundamental step towards achieving financial independence and resilience. And so the core issue is, what are the risks that one is experiencing from a lifestyle and financial perspective to the achievement of those goals, and how are they best addressed? But in technical investment speak, risk and return are seen as two sides of the investment coin, and you need to know where you sit on that risk-return spectrum. There are a number of factors to be considered in determining what's known as your risk profile. One is the period of time for which you're planning to invest, which should be matched to your goals. So long-term goals, such as funding for 20 years plus of retirement expenditure, are generally matched with a portfolio that includes a significant allocation to shares, as they offer the possibility of the highest expected returns, but they have a lot more ups and downs. So one of the challenges in a New Zealand context is that people typically, for example, with their KiwiSaver, go into a default balance scheme. And if you're in your 20s and your 30s and you're thinking about this KiwiSaver as your retirement money, then it may well be the case that it's worth thinking more about your risk profile and whether you can tolerate those ups and downs. But you might switch down to a conservative portfolio at the worst possible time. That's a subject we'll come to later. But in essence, thinking about your risk profile is a key issue which you can work through on websites like Sorted, and there are other resources. But when it comes to risk, another key issue is your emotional comfort level with the ups and downs, for example, of the share market. This is sometimes referred to as the sleep test. Would you be able to sleep at night if your portfolio experienced a substantial negative return, or even knowing that it could? And your response may influence your decision on how much to allocate to shares. So a financial advisor can really help you understand what's to be expected from different types of portfolios and really ascertain and help guide you to the optimal approach for you.
That's a really interesting insight you've just shared there, that risk both has a theoretical element and it also has a personal, can I sleep at night? And actually a bit of coaching and guidance is really helpful in working through, as you say, and finding the optimal point for you personally. So you mentioned portfolio. On Mindful Money, we have a number of what we call managed funds, or you also mentioned KiwiSaver. How do they fit within this process?
Well, many financial advisors will develop a portfolio of managed funds. Managed funds are a medium for indirect investment, so they're not going directly to buy a portfolio of shares, share A, B, C, or D. It's going to buy a portfolio of fund managers and funds who will in turn make those decisions. So a managed fund is a pool of money in which you've got many investors investing and a team of professionals investing on their behalf. So compared with direct investment, you're doing it yourself or going to a broker or whoever and buying direct shares, managed funds come with many benefits, including typically more specialist professional management in particular areas, greater diversification and spreading of risks, and access to more investment opportunities. So advisors can help you choose the optimal managed funds for your plan, your goals, your risk profile, and your ethical profile. And managed funds are decided based on strategies that match an investor's tolerance for risk. And obviously return is linked to risk. A low-risk strategy might deliver low returns with more predictability. Equally, a high-risk strategy might deliver higher returns but could experience more ups and downs. So having an advisor who can independently, again, like the doctor, assess all those different managed funds, like the medications that are out there, and prescribe and monitor those can add extra value.
Yeah, that sounds like a really valuable service because there are a lot of funds. I know we have them on our website. You mentioned Sorted can help you kind of select, or we can help you select, but it's only a tool. What you're saying is the advisor is working with you personally and getting deeper into your circumstances. So what are some of the other ways that you've seen advisors working with clients to sort of navigate all these thoughts and considerations?
I think navigation is a great metaphor, and Shelley uses that with her work around the wayfinding leadership. Part of it is about helping clients navigate the emotions that can cloud financial decision-making. Without the support and guidance of a wise advisor, investors can be their own worst enemies. They can be selling at the bottom through fear or buying at the top through greed. And, those are quite natural. But oftentimes the best strategy is to stay the course with your plan and your portfolio, albeit that there might be changes that an advisor would recommend from time to time in terms of particular investments or approaches. So advisors can help you also sort of assess the trade-offs. For instance, if you want to achieve longer-term goals that require money, you need to save now, and that might mean you can't do as much as you want to in the present. So advisors can help you to consider and work through those options.
Yeah, that sounds great. And it's not so long ago we had COVID, is it? And I know it was pretty scary. We all thought, the world was going into complete meltdown. Markets were in meltdown, and it was pretty scary, if you had a KiwiSaver plan. But doing nothing did turn out to be the right thing to do, didn't it?
provided you, generally speaking. But if you'd been in cash or you'd been in a conservative fund, then you probably didn't benefit as much from what subsequently occurred in terms of the appreciation. And I did have a nephew who was in touch with me, and all his young friends, these are people in their 20s and 30s, were saying to him, goodness me, you need to be in conservative or cash. The world's going to hell in a handbasket. Yeah. And by the way, we've got the timing right, and we'll know when it's best to reinvest. Mm-hmm. And of course, that turned out to be easier said than done. And those people that were out of the market typically experienced a lower return than what would have otherwise. And people that were in a relatively growth-orientated or higher share portfolio, sure, they got the biggest drop typically, but then the biggest gain when things came right.
Yes. So, that's a really important role that advisors play, is just helping to keep you calm and sleep at night. So it does sound like there really is a lot of additional support provided advisors. I think maybe it's a generalisation, but, we Kiwis we like our DIY, don't we? We like our, and in this today's world, we also like to, for medicine, we use Dr. Google. We can also Dr. Google for finance. Getting advice does have a cost. So do you feel the benefits outweigh the cost, or are people better off using Google Advisor?
Well, let's take an example where the cost of financial advice is 1% per annum. And that may or may not be the case in practice. And typically percentages are lower the more investment balance one has. So, for example, with a client with $2 million, they're paying a lower percentage than a client with $100,000 or $500,000. But just for the purpose of the exercise, let's say it's 1%, and that's oftentimes a figure used in the US in the industry. So you then ask the question whether working with an advisor where you're paying, say, 1% will A, increase your return by more than this, B, save you more than that in mistakes that they help you not to make, and or C, save you time, effort and worry that's worth more than this to you, and or, all of those, A, B and C. A recent report from Russell Investments titled The Value of Advice concluded that in New Zealand in 2024, the value of an advisor was 4.7% per annum. Now, you could choose various studies and look at things from different perspectives, but if, for example, the advisor fee was 1%, then in that scenario, the investor would be 3.7% better off for having been a client of such an advisor. So looked at in the context of getting the asset allocation or the mix of investments right, looked at in the context of behavioral coaching, staying the course, it's not difficult to see that there's more than 1% value added.
Yeah, that's really interesting and quite compelling. I'm interested that in Mindful Money's annual survey of attitudes of Kiwis, about half of the responders have received advice at some point. However, only 10% of the responders are getting regular professional advice. So how would you go about finding an advisor in the first place? Because there's still 50% of people have never had any advice. And secondly, and important to what actually both of our organisations are doing, we're really committed to ethical investing. How can you support clients particularly? How can they find an advisor who can support them to invest in line with their values?
Obviously, I'd recommend contacting me. But there's a list of investment advisors on the Mindful Money website. There's also a list of advisors on the Responsible Investment Association Australasia website. And the Ethical Advisors Co-op also has a list of advisors.
Thanks, Rodger. That's helpful to signpost people to resources. I guess the next question that people listening to this might be thinking, do I need to have saved a lot before I visit an advisor? Is this something that's only for really, really wealthy people? You mentioned someone with $2 million. Be nice to have.
Right. There's a challenge because a truly independent advisor will only be paid by the client. They won't be receiving a commission, and to make their business work, they would often have a minimum investment sum and or an annual fee. They might simply specify an amount that one needs to be willing to pay. Those fees are usually made very clear on the website. Some advisors will offer an hourly rate or a setup fee, particularly for creating a financial plan. So there's a spectrum, and you can oftentimes get quote-unquote free advice beware that there's probably someone benefiting from something there. But so long as you're really clear about how the situation is being structured, it's certainly possible to get advice from a wide range of sources. And to start with something like Sorted, and look at the Mindful Money website, look at the Responsible Investment Association Australasia, look at the Co-op website. You can do a fair bit of homework and get a pretty good orientation. And then that can also make the process a lot more efficient and effective when you do engage an advisor.
Okay, that's helpful advice to people. And you could maybe have a conversation with the advisor before you start the process. So once you've sort of done a bit of research and you think you've selected a firm that's sort of aligned with you or in your local area, whatever, what's the first part of the engagement with the advisor?
Well, the first meeting is often at no charge or obligation. This can be an opportunity to, as we describe, ask anything. So you mentioned, in your area, I have had a number of people in New Zealand say that there's limited advice options in the area that they're living, and in this day and age with the ability to jump on a Zoom call, it's possible to have access to highest quality advice, say in the medical analogy, again, getting the best specialist, even though that specialist isn't living, in your, for example, rural area. And of course, you can always connect in person in subsequent visits and trips and things like that. So once you do have that conversation, it's an opportunity to get to know each other. In my case, any questions a person might have, I can address. I can take them through a case study. It's kind of an education session so that they can really understand what's involved, see an example of a plan and portfolio, and really take time then to decide if they're likely to be the right fit. And I think that applies for both parties. Then there are a set of steps that advisors take for clients who want to proceed further. It's important, of course, that you have an advisor that's competent to give you the advice that will meet your particular needs. So the first stage in that process is establishing what the needs of the client are and if the advisor can actually meet those client's needs. And the advisor will then work through a systematic process of gathering information and analysing your situation, after which they'll come to a recommendation, a draft plan. And if the client's happy, they'll then implement this. Of course, any changes can be discussed and implemented as well. This is usually followed by ongoing advice to monitor changes in the client's situation, the financial markets, the funds, as well as many other factors that may require changes to the plan and portfolio.
Great. That's a really helpful overview of the process. And again, coming back to our medical analogy, very similar. As you mentioned, that kind of diagnosis, and then here's the medication, and now we're going to monitor how your health's going. Coming back to ethical investment and Ethical Investment Week, I noticed that the theme is what type of ethical investor are you? So with your long and deep experience, how do you define different types of ethical investors? Are there different types of ethical investors?
Some investors are solely focused on financial returns. These investors may simply not consider the environmental and social impact of their investments, or they might believe that doing so could increase their risk and or reduce their return. So they either don't consider real-world impact or feel it's not something that they can influence through their particular investments. Ethical investors, also known as responsible investors, want to make money, of course, and also make a difference. They really want the best of both. Where some investors focus only on risk and return, ethical, responsible investors add impact to the mix, creating a sort of a shift from, if you like, a two-dimensional mindset to a three-dimensional mindset where we think about risk and return and impact and really open up the world of possibilities to make money and make a difference in an ethical way.
That sounds really exciting that you can think in that three-dimensional way. And we know from Mindful Money's Voices of Aotearoa annual survey that 77% of people expect their money to be invested ethically. In your experience, do most people have a clear idea about the issues that they're concerned about or the good outcomes they want to support? Or is it a bit more general, just want to avoid doing harm to the world, want to do some good? How does an expert advisor help facilitate people to think about this?
Many people coming to Money Matters will have decided that they're wanting to have a relatively strong commitment to this area and so be able to really see what's possible, and we can talk them through that and match that. How do we do the matching process? Well, we can do that across a spectrum of client types by considering what we call an ethical profile questionnaire. So that provides opportunities for the client to tell the advisor about what's most important to you about investing ethically. How would you like your money to matter in making a difference? Our ethical investment profile introduces the question, what kind of ancestor do you want to be? And that's from the book of the same title, which Rodger Spiller contributed a chapter to. She's an integral part of this discussion and brings more of that Indigenous Māori perspective, a perspective about legacy, a perspective about future generations that I think can add important insights. We explain the vision of the United Nations Sustainable Development Goals, the SDGs, and that's a vision of shared prosperity in a sustainable world. And we present those goals, then we ask clients, what type of world did you hope that your ethical investments would contribute to in the future? We then invite an importance rating of these various ethical issues that an investor may want to avoid and support, exclude and include. Next, we ask about particular preferences for exclusion, avoidance, inclusion, support and engagement. And finally, we ask their preference for ethical light, ethical medium and or ethical strong investments. An advisor can explain the spectrum of ethical fund investment options from what Money Matters classifies as light to medium to strong and provide examples of funds and investments within these funds. And it's important that the advisor is independent and objective, helping you to understand the way that different funds work, the advantages and disadvantages of particular approaches, and how funds can be categorized on a spectrum. Investors may want to reflect more on those questions and then return their ethical profile to us after they've done that, or we can just do that in conversation.
So yeah, it sounds like you can think about ethical considerations in the similar sort of structured way, and again, like a doctor, diagnosing where do you sit on that spectrum. I personally love that concept of the what kind of ancestor do you want to be. I've got some ancestors I'm not particularly proud of, if I'm honest. I'm a Pākehā Kiwi, so, it's inevitable. But yeah, it is something I think about. What do I want next generations to think about my generation? So if an investor cares deeply about people and planet and wants to make money via ethically strong investments, what sort of portfolio would that involve?
Well, if an investor wants an ethical strong, to use our terminology, plan and portfolio, they are seeking investments that are providing solutions to sustainability challenges and that have a significant, measurable, positive impact on the achievement of the United Nations Sustainable Development Goals. For an ethical strong investor, they'll want negative screening or exclusions and avoidance of a wide range of unethical activities above the highest bar and threshold. They'll want a high level of engagement with companies to encourage change. They want to see strong voting in favour of shareholder proposals for environmental and or social action. Other clients may prefer a less ethical strong portfolio. For example, they may prefer some or all of their portfolio to be in what Money Matters describes as ethical light, which involves some negative screening, excluding and avoiding some of the most unethical activities like tobacco production, but often above a relatively light, lower bar threshold. There'll be a relatively low level of engagement with companies to encourage change, less voting in favour of shareholder proposals for environmental and or social action. They might even vote against them or abstain, and usually not including a focus on companies that are dedicated to creating products and services that measurably have the strongest benefits for people and planet.
It's interesting to consider that there is a spectrum, and the ethically strong does give you all those benefits of having the positive achievement, but it can appear a bit confusing to people, can't it? So how else can an advisor help navigate the options?
Well, there are a range of solutions out there, and as you say, many, many options. In fact, these days, it's often the case that the term ethical and sustainable is associated with the majority of funds from a particular organisation, whereas for a very long time when I was starting my career in the 80s and 90s, it was considered pretty wacko. And there are a number of organisations who explicitly stated on their marketing material, don't worry, we're not taking account of ethics. We're not ethical. You can relax. times they have changed, as Bob Dylan would say. But anyway, the Ethical Advisors Co-op is a resource that provides useful insights. It's a group of advisors, and together we rate the perception that we have of the various ethical funds. There's a system called leaf ratings that has a spectrum going from excellent, or 5 leafs, which means the fund meets all the ethical objectives of an average investor, to what we call poor, or it's 1 leaf, and the fund doesn't meet the ethical objectives of an average investor. So the advisors are looking at the particular fund's ethics, its environmental and social credentials, the underlying investments, the research the fund is undertaking, its screening methods, its voting records, its engagement on important issues. And those are available online at no charge from the Co-op website. It doesn't have coverage, particularly in the New Zealand context yet, primarily Australian-based funds, although a number of those funds are used in New Zealand portfolios. The Responsible Investment Association Australasia also has a certification system for funds, so people can go on there and look at their responsible returns and other resources at the website. An expert independent ethical advisor can understand what a fund can and can't do ethically and explain that to you, help you navigate the claims that funds make versus the realities, create a plan and portfolio that reflects your financial and ethical investing goals. And the advisor will usually have access to specialist third-party research firms that are in the business of in-depth analysis of funds. Typically, that has been from a financial perspective, risk and return, but increasingly those firms are now, in fact, most of them have another rating, which is from the perspective of ethical investment, taking account of environmental and social governance issues, ESG, and also impact. So that research is exceptionally valuable. And of course, we've got Mindful Money as another excellent resource for people to check out. And many advisors are tapping into that resource as part of their process.
Yeah, so again, it's about that role of the advisor as the expert researcher, the specialist in the field who's helping to navigate the different options and making sure that if you're ethically strong, you're going to get an ethically strong fund. Another question that people sometimes ask, even if they're very motivated about doing good for planet and people, is there a trade-off? Do you have to accept lower returns or more risk if you want to have, say, the ethical strong portfolio or any variant? Is there a trade-off?
Well, many investors and business leaders now believe that the consideration of ethical issues doesn't compromise financial performance. In fact, many believe the opposite to be true, that ethical investing can often increase return and reduce risk. They cite factors such as attracting, retaining, and enhancing the productivity of employees, improving customer sales and loyalty, increasing supplier commitment, contributing to environmental sustainability, reducing legislative demands, strengthening community and government relations. They believe that management quality can be improved, and when combined with enhanced relationships with those various stakeholders, that can result in improved financial performance for shareholders. Of course, if we are investing primarily in ethical and socially responsible investments, that has to carry a health warning, if you like, that, and this is using some of the jargon from the US market, quote unquote, investments carry the risk that under certain market conditions and assessed over a short period, the portfolio may underperform strategies that do not utilize an ethical investing approach. But of course, there's all sorts of approaches that get applied out there in the investment world. Some might say we're going to invest in large companies. Some might say small companies. Some might say value stocks. Some might say growth stocks, and we could go on. They're all particular approaches that can under and overperform and do, at particular times. And they're under and overperforming this concept of the index, which is basically all companies. And if you've got an ethical investment portfolio and all you do is achieve the same return as the share market index over the long term, consistently quarter by quarter, you'd have to sort of wonder, well, what's different about my portfolio? And for me, I just think that the existing business as usual, the share market as usual, has got a number of issues with it, and that there are some pretty intelligent, wise reasons why you'd want to do something different. And that's certainly what ethical investment can argue. We have to, of course, say that critics say, well, if you exclude tobacco, for example, heaven forbid, or limit exposure to certain, quote unquote, sin stocks or different sectors, then that might reduce the ability of investors to adequately diversify. And they also argue that to the extent an ethical portfolio has fewer of the very largest companies, then performance might be more volatile than the overall market. Now, an ethical, strong investor understands, particularly if they're working with an advisor who's explained all these things as we're required to do, understands and accepts that ethical, strong funds invest in fewer companies. They're therefore less diversified than a lighter ethical fund or a conventional fund. However, an ethical, strong portfolio may still have hundreds of companies. They're going to have a comparison with other funds that arguably might have companies with poor practices, for example, regarding environmental matters where a company could get large fines for a major pollution incident or be badly affected by climate change. So, indeed, I have dedicated a fair amount of my PhD, but there's PhDs being written as we speak that are making the business case for why it is wise to invest ethically. And there are a number of fund managers who are pouring a lot of time and energy into explaining, unpacking for investors how the particular focus that they have in relation to the ethical investment challenge has, over the longer term, added additional value.
And I think that's a key point. Really, any of these, ideally investments are held over a longer term and for a longer term horizon, trying to kind of time the markets and get the short-term kind of win, sell at the up and always buy at the down is probably really hard to do, isn't it? Even the most sophisticated person who's spending every waking minute following the markets would struggle to do that. So that long-term horizon is pretty important, isn't it? And we are in a world that is changing really rapidly. So I think it's possible that experience of the past may not translate into the future. So an ethically strong portfolio may actually be a more safe portfolio than a traditional one. Maybe the traditional one should have the health warning. Anyway, thanks so much, Rodger, for sharing the benefits of your long experience and, your deep reflections on really all the considerations, like what sort of legacy do you want to leave? I hope this has helped to demystify for listeners how advice works and how it can help you to get an ethical investment that meets your financial goal. If you would like to understand more about some of the terms used, then do look at our resources on Mindful Money website, resources that Rodger mentioned on Money Matters, resources like Sorted. And if you'd like to know more about Ethical Advisors Co-op and Ethical Investment Week activities, where do you suggest people go, Rodger?
There's the website ethicaladvisorscoop.org to learn more from Money Matters and to see some of our contributions to Ethical Investment Week 2024, for which we have a range of podcasts and blogs. Check out moneymatters.co.nz. or feel free to give me a call, 09366 1672, or email me, Rodger with a D, at moneymatters.co.nz.
Thanks for a very informative conversation, Rodger, and thanks for listening, everybody. Huri noa, tēnā koutou katoa.
Thank you very much, Kate. I appreciate the opportunity to chat and discuss how to work with a financial advisor, and I wish listeners all the very best with your ethical investment journeys. Now for the disclaimer. The views and opinions expressed in this podcast interview are those of the participants and do not necessarily reflect the official policy or position of Mindful Money or Money Matters. This content provided is for information purposes only and should not be construed as investment advice or an endorsement of any specific investment product or strategy. Any references to specific products shouldn't be considered as recommendations to buy, sell, or hold such investments. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Mindful Money and Money Matters do not endorse or recommend any specific investment products or services or approaches mentioned in the podcast interview, and of course, past performance is not indicative of future results. All that said, in summary, this isn't part of the disclaimer, there is plenty of research that shows it's possible to do well and do good, make money and make a difference.
Thanks again, Rodger, and thanks for listening, everybody.